now the probability of a double dip is unlikely. This is the rhetoric that came from Omigsa Quarterley Briefing held a little earlier today. Omigsa has attached a 55% probability to gradual healing and normalisation in the global economy this year. Samantha caught up with Johann Els, senior economist at Omigsa, and asked him just what was meant by gradual normalisation and recovery.
Gradual normalisation means in about 2 or 3 years' time, we'll pick up growth gradually. But for this year, much better than what people anticipated about 6 months ago, but still gradual growth. But at least it doesn't mean a double dip, because 6 months ago, people feared a double dip, global recession, falling back into a similar situation as 2008, and this is not it.
What does this mean for monetary policy when we're looking at the key economies like China, of course, like Europe and the United States?
Well, it's still not fantastic growth. And in the developed markets, lots of fiscal tightening is set to continue for many years to come. So we expect in the developed economies, US, Europe, Japan, of course, and the UK, for interest rates to remain at zero for many years still, for many, many years, longer than what we previously expected. And in the emerging economies, because we've seen a little bit lower growth, but we also see inflation falling quite rapidly now. Chinese inflation down from 6.5 to 4.1 in 6 months. So we expect interest rates to be cut in many, many emerging economies out there. And that will support growth as well.
Let's just quickly focus in on the USA, because the data out of the America continues to surprise to the upside. Results appear to be stronger than expected from companies that have been reporting so far. Anecdotal stories that you're hearing from people who live in the United States is there's a sense of optimism that is back in the market. Could the USA be a mini engine for growth in 2012?
I certainly think so. In the face of a European slowdown, in the face of slower growth elsewhere, and in the face of expectations for slow or double dip in the USA as well, I think we're going to be surprised. The data, as you say, over the last 6 weeks or so, all of them better than expected. Now, even though if it doesn't continue in the same pace over the next 6 months, I think the US economy can show 2.5% growth this year. Now, admittedly, it's nothing exciting, but yes, we've seen that optimism coming back. Consumers are continuing to spend. The labor market continues to improve, albeit at the slowest pace, but companies, as you say, are very healthy, very profitable, huge cash flows still. So they will continue to spend on the two things that they spend on, and that's hiring new employees and fixed investment.
Whilst there's a lot of focus on China and the soft landing versus the hard landing, you're factoring in a soft landing. Their growth numbers have been softer, but 8.9% is, I'd say, by any standards, a strong growth. What about India, though? Do we need to focus in on the rising prominence and power that India will have going forward?
Yes, I think so. But I think it's still a couple of years before India can get close to the Chinese impact on the global economy. But India hasn't really started with their fixed investment cycle. And they've got lots to do, all that urbanization, all that roads and railways that needs to be built. I think it's a slow start, but yes, certainly with India's rapid urbanization, huge population, it will eventually come close to China.
For South Africa, you're forecasting 2.7% growth of GDP in 2012. Now, that's far below our counterparts in BRIC economies. Why do we continue to underperform?
Well, lots of cyclical and fundamental structural problems in the South African economy. But on a cyclical basis, yes, we've lagged a little bit. Our exports are a little bit under pressure now with the global slowdown. But once again, it's not 2008 when we had a huge knock on our exports. We've seen the consumer still struggling, huge debt levels, banks hesitant to lend out too much. So the consumer has been under pressure. Although the consumer's been driving what GDP growth we've had up to now, we expect some slowdown in the consumer spending this year as inflation has been on the uptrend and we see somewhat slower after-tax income growth. So a tighter situation for the South African consumer. Not a train smash, but slower consumer spending growth. But on the other hand, fixed investment spending growth, which normally lags the economic cycle, that's busy picking up, and we expect that to continue to pick up. And yes, you're right, it's slowish growth, but at least it's decent growth.
You're seeming a lot more optimistic about the state of the global economy than the last time I spoke to you, which was about 3 months ago. But what are the big risk factors that could blow your GDP forecast out of the water for 2012?
I have to admit the European debt situation is still a big risk because we've seen our policymakers have messed up what they do there. So that's still a big risk. However, I think the probability of a mess up in Europe has reduced over the last 6 months or so. We've seen the ECB becoming far more aggressive in terms of the willingness to sort out the problem. So I would place a very low probability of the European situation blowing up. So that's still a risk. It will mean volatility in markets, but I think that's far reduced. Lots of investors are still worried about a hard landing in China. I just don't think that will happen. The Chinese authorities have been very proficient in engineering soft landings. They've got lots of policy room in terms of monetary and fiscal policy, and they will use that. There's other unforecastables we don't know. Last year we had lots of shocks, Middle East, North Africa uprising, the oil price, the Japanese tsunami and earthquake. We don't know what will happen. I think there's a risk of Iran out there which could cause the oil price to spike up. That subtracts from growth if that should happen. Other things we simply can't forecast. I just think that on balance, given all the negatives last year, we could expect positive surprises this year compared to the negative risks of last year.